The global trade landscape shifted dramatically in recent months with significant implications for various industries and economies around the world. One of the most impactful changes was the United States' decision to impose a 100% tariff on Chinese electric vehicles, a move that has sparked widespread debate and concern. This bold move, aimed at protecting the American auto industry from foreign competition, sent shockwaves through international markets, causing immediate reactions from traders and investors. The U.S. government argued that Chinese EV manufacturers benefited from unfair subsidies and intellectual property theft, which gave them an undue advantage in the global market. By imposing these tariffs, they claimed, the playing field would be leveled, allowing American companies to compete more fairly and potentially boosting domestic production and job creation. However, the decision was met with immediate condemnation from China, which saw the tariffs as a direct attack on its growing electric vehicle industry. Beijing denounced the tariffs as protectionist and warned of retaliatory measures that could further escalate tensions between the two economic giants. The world watched anxiously, aware that a full-blown trade war between the world's two largest economies could have devastating consequences for global trade and economic stability. The electric vehicle market, considered a key sector for future growth and environmental sustainability, became the first casualty in this escalating trade conflict. The U.S. tariffs threatened to stifle Chinese EV companies' ambitions to expand their global market share, potentially slowing down innovation and progress in the industry. Meanwhile, American consumers faced the prospect of higher prices for electric vehicles, potentially hindering the adoption of this environmentally friendly technology. This could slow down the transition to greener transportation options, which is crucial for combating climate change. Analysts are divided on the long-term impact of these tariffs. Some believe they will ultimately benefit the U.S. economy by fostering local innovation and production, while others warn of the potential for a prolonged trade war that could harm both nations' economies. As the situation continues to unfold, international leaders are calling for dialogue and negotiation to prevent further escalation and to find a mutually beneficial resolution. The future of the electric vehicle market hangs in the balance, with the potential for significant shifts depending on the outcomes of these trade policies and negotiations. The world watches closely, hoping for a resolution that supports innovation, fair competition, and environmental sustainability. China wasted no time in responding to the U.S. tariffs on its electric vehicles. In a move that sent shockwaves through global markets, Beijing announced retaliatory tariffs of up to 145% on a range of American goods. The message was clear: China would not back down from a trade war. These tariffs were carefully calibrated to inflict maximum pain on key U.S. sectors. Agricultural products, a major export to China, were among the hardest hit. Soybeans, corn, wheat, and other agricultural commodities faced steep tariffs, threatening the livelihoods of American farmers who relied heavily on the Chinese market. The automotive industry, already reeling from the initial U.S. tariffs, was dealt another blow. American car makers exporting to China faced significantly higher costs, making their products less competitive. Luxury goods from high-end fashion to premium spirits were also targeted, as were raw materials like rare earth minerals, crucial for U.S. tech companies. China's retaliatory tariffs were strategically designed to target key U.S. industries, maximizing economic pain and increasing political pressure on the American government. These tariffs were not random. They were carefully calculated to hit sectors that are crucial to the U.S. economy, thereby creating ripple effects that would be felt across the nation. By focusing on these key industries, China aimed to leverage its economic power to force the U.S. into a more favorable negotiating position. The agricultural sector, heavily reliant on exports to China, was particularly vulnerable. American farmers, who had long depended on the Chinese market for a significant portion of their sales, suddenly found themselves with surplus crops and no buyers. This sector, which includes soybeans, corn, and pork, saw immediate and severe impacts. The loss of the Chinese market meant that farmers had to scramble to find alternative buyers, often at much lower prices. American farmers, already grappling with low commodity prices, faced a double whammy of lost market share and plummeting incomes. The financial strain was palpable, with many farmers struggling to cover their operational costs. The uncertainty of future trade relations added to their woes, making it difficult to plan for the next planting season. This economic distress also had a psychological toll, leading to increased stress and anxiety among farming communities. The automotive industry, another pillar of the U.S. economy, found itself caught in the crossfire. This sector, which employs hundreds of thousands of Americans, was hit hard by the tariffs. The industry relies heavily on a global supply chain, and the increased costs of imported parts due to tariffs made it more expensive to produce vehicles in the U.S. This, in turn, affected the prices of cars, making them less competitive both domestically and internationally. American carmakers exporting to China faced a significant price disadvantage, while those manufacturing in the U.S. for the domestic market grappled with higher costs for imported parts. This dual challenge put immense pressure on the industry, leading to concerns about potential layoffs and plant closures. The ripple effects were felt throughout the supply chain, affecting not just car manufacturers but also parts suppliers and dealerships. The tariffs threatened jobs and profits across the entire automotive supply chain. From the workers on the assembly lines to the engineers designing new models, everyone felt the impact. The uncertainty surrounding trade policies made it difficult for companies to make long-term investments, further stifling innovation and growth in the industry. The potential for job losses also had a broader economic impact, affecting local economies dependent on the automotive sector. The technology sector, a shining star of the American economy, was not spared either. Known for its innovation and global reach, this sector faced its own set of challenges due to the tariffs. Companies that relied on rare earth minerals, which are crucial for manufacturing electronic devices, found themselves in a precarious position. The increased costs of these essential materials threatened to disrupt production schedules and increase prices for consumers. China's tariffs on rare earth minerals, essential components in smartphones, computers, and other electronic devices, sent shockwaves through Silicon Valley. These minerals are not easily sourced from other countries, making the tech industry particularly vulnerable. The increased costs and potential supply chain disruptions posed a significant risk to the sector's growth and innovation. Companies had to quickly adapt, seeking alternative suppliers and re-evaluating their production strategies. These tariffs threatened to disrupt supply chains, increase production costs, and potentially stifle innovation in this critical industry. The long-term implications were concerning, as the tech sector is a major driver of economic growth and job creation in the U.S. The uncertainty surrounding trade relations with China added another layer of complexity, making it difficult for companies to plan for the future. The potential for increased costs and supply chain disruptions loomed large, casting a shadow over the industry's prospects. The potential slowdown in AI development due to these tariffs cannot be overlooked. AI, which relies heavily on advanced hardware and rare earth minerals, could face significant setbacks. The increased costs and supply chain disruptions could delay research and development, impacting the U.S. As competitive edge in this crucial field. The implications are far-reaching, as AI is poised to revolutionize various industries from healthcare to finance. A slowdown in AI development could hinder innovation and economic growth, affecting the U.S. position as a global leader in technology. The ripple effects of a slowdown in AI development could be profound. Industries that are on the cusp of transformation through AI could see delays in realizing their full potential. This could impact everything from job creation to advancements in critical sectors like healthcare and transportation. The U.S. must navigate these challenges carefully to maintain its leadership in AI and ensure that the benefits of this transformative technology are fully realized. The escalating trade war between the United States and China sent shockwaves through the global economy. What began as a series of tariffs and counter-tariffs quickly spiraled into a full-blown economic conflict, affecting industries and markets worldwide. Financial markets reacted nervously, with stock prices fluctuating wildly as investors grappled with the uncertainty. The volatility was unprecedented, with some stocks experiencing dramatic swings within a single trading day. Analysts and traders were on edge, trying to predict the next move in this high-stakes economic chess game. The International Monetary Fund warned that the tariffs could shave off a significant percentage of global economic growth, highlighting the interconnected nature of the world economy. Economists from various institutions echoed these concerns, emphasizing that no country would be immune to the fallout. For exporters in both countries, the tariffs created significant challenges. American exporters found themselves at a disadvantage in key markets, while Chinese exporters faced similar hurdles. The ripple effects were felt across various sectors, from technology to agriculture. American farmers struggled to find alternative markets for their products, as traditional buyers turned to other sources. The agricultural sector, already dealing with issues like climate change and fluctuating commodity prices, now had to navigate this new obstacle. Meanwhile, Chinese manufacturers faced higher costs for imported raw materials and components. This increase in production costs forced many companies to either absorb the losses or pass them on to consumers, neither of which were ideal solutions. Consumers on both sides of the Pacific felt the pinch as prices for a wide range of goods began to rise. Everyday items from electronics to clothing saw price hikes, making life more expensive for ordinary people. This added financial strain led to reduced consumer spending, further slowing economic growth. The tariffs also threatened to disrupt global supply chains that had been built over decades. Companies that relied on these intricate networks for their operations faced delays and increased costs, prompting a re-evaluation of their supply chain strategies. Companies began to explore alternative sourcing options, potentially shifting production away from both China and the United States. Countries like Vietnam and India emerged as potential new hubs for manufacturing, as businesses sought to mitigate risks and diversify their supply chains. This uncertainty and disruption had a chilling effect on investment and business confidence, further clouding the economic outlook. Companies were hesitant to make long-term commitments, and investors were wary of the unpredictable market conditions. The global economy, already fragile, faced an uncertain future as the trade war showed no signs of abating.